In 2008, the global financial system came right to the edge of collapse, and some of the people closest to it made billions of dollars.
Now, I don't mean after the crash. I mean during it. As millions of people were losing their homes, their jobs, their life savings, a very small group had already put themselves in a position to win.
I know, it sounds like some kind of conspiracy theory, but it isn't. You see, they weren't just reacting to events. They were prepared for them.
So the real question here isn't just about who caused the crash. It's about who knew it was coming, and maybe more importantly, why nothing was done to stop it. And to understand that, you have to look past the headlines and into the actual design of the system that made the whole thing possible.
All right, so to really get what happened, we have to go back a bit to the early 2000s. The general feeling back then? Well, it was simple optimism. The dot-com bubble had burst, sure, but something else rushed in to take its place: housing. And in the US, owning a home, well, it stopped being just a goal. It became an expectation.
And for a long, long time, that expectation felt completely safe. Why? Because for decades, house prices had really only done one thing: go up. It almost felt like a law of nature. You buy a house today, you sell it for more tomorrow. It was easy money.
Now, this belief, it fueled something new. Banks started lending more money, and then faster, and then, pretty soon, to almost anyone. These loans were called subprime mortgages, and what that really means is they were loans given to people who, statistically speaking, were probably not going to be able to pay them back. It got to the point where if you had a job, you could get a mortgage, and if you didn't have a job, well, you could probably still get one. But nobody seemed to care all that much because the entire system was running on one single assumption: that house prices would just keep going up, forever.
And this is where the story takes a turn. See, the banks weren't just making money from the interest on these loans anymore. They had figured out a way to take those simple loans and turn them into something else, something much bigger, much more complex, and something global.
So here's what they did. The banks didn't just hand out mortgages and then wait to get paid back. They sold the mortgages themselves. Not the houses, to be clear, but the actual loans. They would take thousands of these mortgages, the good ones, the bad ones, all of them, and bundle them together into these really complex financial products. And then they sold those products to investors all over the world. We're talking pension funds, insurance companies, even other governments.
And everybody, I mean everybody, wanted a piece of this action. Why? Because these bundles, these securities, they were officially rated as safe. Extremely safe, in fact. Some of them even got the highest rating you can possibly get, AAA. So on paper, they looked practically risk-free, but hidden inside that shiny AAA rating were thousands upon thousands of incredibly risky loans, the kinds of loans that were guaranteed to fail the second the economy took a downturn.
So you have to ask, why didn't anyone stop this? Well, because the system was designed to reward blindness. Think about it. The banks made a fee for creating the loans. The investors made money from buying them. And the rating agencies, the very people who were supposed to be the independent judges of risk, they were getting paid by the banks. The more of these products they approved, the more money everybody made. So you just keep building the tower, higher and higher. You ignore the cracks in the foundation.
Okay, and this is where the whole story starts to get really uncomfortable. Because this crisis, it wasn't just about a few bad apples or a couple of greedy bankers. It was about the incentives that were built directly into the design of this system itself.
Here's the most important part to understand. The banks, they weren't holding on to these risky loans. They were immediately passing them on to someone else. And what that meant was they had absolutely no reason to care if the person taking out the loan could ever actually pay it back. Because the risk, it wasn't theirs anymore. It had been transferred. It was hidden. It was sold.
I want you to imagine something. Let's say you're a banker. Your annual bonus is based on how many of these loan products you can create and sell this year. It has nothing to do with whether those loans actually get paid back 5 or 10 years from now. What do? Well, the logical thing to do is to maximize the present. You ignore the future. Because by the time the whole thing breaks, you've already gotten your bonus. You've already been paid. Now, that's not a mistake in the system. That is the system. That's the design.
But it gets even deeper than that. See, a few investors, they saw the cracks forming. They looked at the numbers and realized all these mortgages were going to fail. So they did something pretty unusual. They decided to bet against the housing market. They used these financial tools called credit default swaps. And the simplest way to explain it is this. It was like buying fire insurance on a house that you don't even own and then just waiting for it to burn down.
And this might be the most uncomfortable truth of all.
some of the very same banks and institutions that were creating and selling these products to their clients were also, at the exact same time, betting that those same products would fail. So let that sink in. They sold a product that they knew was going to fall apart, while privately making bets that it would do exactly that.
Now you have to ask, is that illegal? Well, not necessarily. But is it ethical? That's a very different question. Because what the system had created, at its core, was a situation where the smartest financial move you could make was to help the system collapse.
And eventually, inevitably, housing prices stopped rising. And when they did, the whole thing just unraveled. Homeowners started defaulting on their loans, those supposedly safe securities became worthless overnight, panic spread like a virus through the markets, credit just froze, and all of a sudden, the entire global economy was staring into the abyss.
Of course, governments had to step in. The major banks, the ones at the center of the storm, were deemed too big to fail and were bailed out. But ordinary people, well, they lost their homes, they lost their jobs, they lost their retirement savings.
We're talking about trillions of dollars in public money, taxpayer money, that was used to stabilize the very system that had caused the crisis in the first place.
And this brings us to the part that really still affects us today. Because after all of that, the system didn't fundamentally change. Sure, some new regulations are added. There are some new safeguards in place. But the core incentives that drove the whole thing, they're basically still there. Short-term rewards still matter more than long-term risk. The world of finance is still so complex that it's almost impossible for an outsider to see where the next danger is building up. The fundamental structure, it's all uncomfortably familiar. Look, the 2008 crisis wasn't the result of some secret plot hatched in a dark room. It didn't need to be. Because when you have a system that rewards the very behavior that leads to its own collapse, well then collapse becomes inevitable. It's not planned, no, but it is predictable. And that really is the most unsettling part of all of this. The danger isn't hiding in the shadows. It's embedded right there in the rules of the game.
Which, it brings us to one final lingering question. If the system is still set up to reward taking massive risks, and it shields people from the consequences of those risks, then what exactly is stopping it from happening all over again? The real question isn't whether this was all built on purpose. It's whether anyone in a position of power has a real incentive to stop it the next time it happens.